Friends, thank you for being here today. What if I told you that the United States government didn't just fine a Canadian bank, they effectively seized control of it? What if the invisible hand that used to guide free markets has been replaced by a regulatory fist that can crush an entire nation's financial sovereignty with a single decree? We are not talking about a conspiracy. We are talking about a documented asset cap that has turned Canada's second largest bank into a zombie institution, alive but forbidden to grow, answering not to its shareholders in Toronto, but to regulators in Washington. The number is staggering $434 billion. That is the exact ceiling placed on TD Bank's U.S. operations by the Office of the Comptroller of the Currency. Not a fine you pay once and move on. This is a governance leash that dictates the daily operations of a systemically important Canadian bank. And this part has already begun. This is a structural fault line. The asset cap is not a temporary punishment. It is a permanent handcuff. And what I am about to show you is how this single regulatory action has exposed the most dangerous vulnerability in the Canadian economy, the illusion of economic independence. Let me be precise. This story begins not with scandal, but with dependency. To understand why the TD Bank asset cap represents financial colonization, we must start at the foundation. We must go back to the architecture of Canadian banking expansion, to the moment when our largest institutions made a fateful choice to build their growth engines on American soil. TD Bank spent decades constructing what it called its U.S. retail footprint. By 2024, the American market was providing roughly 30 to 40% of TD's net income. The bank had become one of the top 10 retail banks in the United States, with over 1,200 branches stretching from Maine to Florida. This was not diversification. This was dependency. Here's the part nobody expects. The simple logic of international banking does not apply here. When a Canadian bank operates in the United States, it does not merely follow American rules, it submits to American sovereignty. Every branch, every mortgage, every checking account becomes subject not to Ottawa's oversight, but to Washington's discretion. And this is where the first domino falls. In October 2024, the U.S. Department of Justice and the OCC didn't just impose a record $3 billion penalty on TD Bank for anti-money laundering failures. That was the headline. But buried in the enforcement action was a weapon far more devastating than any fine: the asset cap. The freeze works like this. As of September 30th, 2024, TD Bank's U.S. retail operations held exactly $434 billion in assets. The OCC declared that this number would not grow, not by one penny, not one new mortgage, not one expanded credit line. The growth engine was not damaged, it was surgically removed. Let me show you what actually happened. To comply with the cap, TD couldn't simply stop growing. The bank had to shrink. By late 2025, analysts confirmed that TD shed approximately $48 billion in U.S. assets. They sold mortgage portfolios. They liquidated securities. They turned away profitable business. This wasn't strategic repositioning. This was forced retreat. But that's not the real problem. The real problem is that the asset cap gives U.S. regulators permanent veto power over TD's business decisions. Can TD open a new branch in Tampa? No, banned until the cap is lifted. Can they launch a competitive credit card to win market share from Chase? Not without explicit permission from Washington. Can they acquire a smaller regional bank to improve efficiency? Absolutely not. What I call the big secret of the entire system is this: the United States has effectively nationalized the decision-making authority of Canada's second largest company without firing a single shot, without passing a single tariff, without any formal declaration of economic warfare. And here's where everything changes. This is vanishing in real time. The sovereignty of Canadian banking is not a philosophical concern. It is an observable phenomenon that is eroding quarter by quarter. Let me walk you through the mechanism, the one hiding in plain sight. TD Bank is a systemically important bank. That designation, SIB, means that if TD fails or falters, it threatens the stability of the entire Canadian financial system. Your mortgage, your pension, your business loan, all of it flows through institutions like TD. The Canadian government has deemed these banks too important to fail. But now a foreign government controls how large this bank is allowed to become. Think about that structure. Washington has placed a hard ceiling on the growth capacity of an institution that Canada itself has declared critical to national economic stability. Here's what that looks like on the ground. TD's compliance costs have exploded. The bank is now spending hundreds of millions of dollars annually on what they call remediation. That's corporate speak for hiring an army of American compliance officers, American lawyers, American monitors to police every transaction, every hire, every strategic decision. Let's cut through the noise. Canadian profits, the fees you pay on your checking account, the interest on your credit card, are being siphoned off to pay American overseers. The irony is mathematical. TD customers are funding their own bank's subjugation. But this isn't even the part that scares me. The part that should terrify every Canadian is the precedent. This enforcement model was pioneered on Wells Fargo in 2018 after their fake account scandal. The Federal Reserve imposed an asset cap on Wells that lasted 6 years and cost the bank tens of billions in lost market value. But Wells Fargo is American. The punishment, however severe, was domestic discipline. TD Bank is not American. This is the first time the United States has placed a permanent growth restriction on a foreign systemically important bank. And once this shifts, everything above it starts to shake, because what comes next is worse. Let me show you the cascade. When a bank cannot grow, it cannot deploy capital efficiently. Capital that would have been invested in new loans, new branches, new technology in the US must now be repatriated to Canada or returned to shareholders through buybacks. At first glance, this sounds positive. More money flowing back to Canada, right? Here's the detail even analysts tend to miss. Capital returning because there's no opportunity is not the same as capital returning because of strength. It is a signal of constraint. It is a retreat, and investors see it immediately. Since the asset cap was announced, TD's stock has structurally underperformed its peers. Royal Bank of Canada and Bank of Montreal, both operating without U.S. regulatory shackles, have seen their valuations hold steady or rise. TD has lagged. This isn't a temporary dip. This is a permanent repricing based on lost growth potential. And here is where the cascade becomes unstoppable. Who owns TD Bank stock? The Canada Pension Plan, every major Canadian mutual fund, every retirement account that holds broad Canadian equity indexes. When TD underperforms, millions of Canadians lose wealth, not because the bank made bad decisions, but because a foreign regulator decided to freeze its expansion. This part isn't a prediction, it's math. The CPP Investment Board holds billions in TD shares. As those shares stagnate, the returns that fund Canadian retirement shrink. We are witnessing the quiet erosion of national wealth, approved and enforced by Washington. But once this shifts, everything above it starts to shake. This is not theoretical, it's observable. We are seeing TD enter what market analysts are calling a utility phase. The bank will continue to operate, it will pay dividends, but it will offer zero growth. For a major financial institution, zero growth is a death sentence in slow motion. Capital flees, talent leaves, innovation stops. And this is where the countdown quietly began. Because the asset cap doesn't exist in isolation, it exists within the broader architecture of US Canada economic relations. And that architecture is about to be stress tested like never before. The United States Mexico Canada Agreement, USMCA, comes up for review in 2026. Trade negotiations will be tense, tariffs will be threatened, concessions will be demanded. And here's the part they never put in the official reports. The United States no longer needs new tariffs to pressure Canada. They already have their hands around the throat of our second biggest bank. Let me be precise. If the US administration wants leverage in trade negotiations, they don't need to impose automotive tariffs or lumber duties. They simply need to tighten enforcement on TD. They can extend the asset cap indefinitely. They can add new compliance requirements. They can make life so operationally difficult that TD is forced to either spin off its US operations entirely or accept permanent second tier status. This is not a conspiracy, it is a stated power. The regulatory authority is already in place. The mechanism is already built, and this part has already begun. We don't have months. This is happening in days. Every quarterly earnings call, TD executives are asked the same question: when will the asset cap be lifted? And every quarter, the answer is the same: we don't know. That uncertainty is corrosive. It prevents long term planning. It forces defensive positioning. It turns a growth institution into a survival operation. Here's the moment the clock actually starts. And here is where the crack becomes an earthquake. The asset cap on TD Bank is not an isolated regulatory action, it is a template. What the United States has done to TD, it can do to any foreign financial institution that operates on American soil. Royal Bank has significant U.S. operations. Bank of Montreal owns Bank of the West. Scotiabank has a Caribbean and Latin American network that touches U.S. financial rails. This is the mechanism hiding in plain sight. Every Canadian bank with cross border ambitions is now watching TD and recalculating risk. The message from Washington is unambiguous. If you operate here, you operate at our discretion. Your growth, your strategy, your very existence in our market is a privilege we can revoke. And this is where everything changes. Let me show you what actually happened in the months following the cap announcement. TD didn't just freeze expansion. The bank began a systematic withdrawal from competitive US markets. They stopped bidding aggressively for deposits. They pulled back from commercial lending competitions where margins were tight. They became, in the words of one industry analyst, institutionally passive. Here's what that looks like on the ground. Small and medium sized businesses in Florida, New Jersey, Pennsylvania, states where TD had built significant market share, suddenly found their banking relationships cooling. Credit lines that would have been renewed automatically were being scrutinized. Loan applications that would have been approved in days were taking weeks. This is not because TD wanted to retreat, it's because the asset cap creates a zero sum game. Every dollar lent to a new customer means a dollar must be withdrawn from somewhere else. Every mortgage originated means another mortgage must be sold. The bank isn't managing growth. It's managing a shrinking cage. For the average household, this means fewer competitive options. When TD stops fighting for your business, Chase and Bank of America have less reason to offer you better rates. The asset cap doesn't just hurt TD, it reduces competition across the entire U.S. banking sector in the markets where TD operates. But that's not the real problem. The real problem is capital allocation. TD is sitting on billions of dollars in excess capital that it cannot deploy in its most profitable market. That capital is trapped. And trapped capital doesn't sit idle, it demands a return. So, what does TD do? Let's cut through the noise. The bank has three options, and all of them are bad. Option one, return the capital to shareholders through massive buybacks and increased dividends. This sounds shareholder friendly, but it's a confession of defeat. It says, we have no growth opportunities, so take your money back. Stock buybacks are what companies do when they've run out of ideas. Option two, deploy the capital in Canada, where TD already dominates the market. But Canada is a saturated banking market. There are only so many mortgages you can write, only so many credit cards you can issue. Forcing excess capital into an already mature market creates inefficiency and drives down returns. Option three, look for international expansion outside the US. But here's the part the experts gloss over. TD spent 20 years building US expertise, US relationships, US infrastructure. Pivoting to Europe or Asia means starting from scratch, competing against entrenched players, navigating unfamiliar regulations. It's not impossible, but it's wildly inefficient. This data forces one conclusion. The asset cap hasn't just limited TD's growth, it has trapped the bank in a strategic dead end. And here's where the first domino falls, because capital doesn't just want return, it wants options. When institutional investors look at TD, they see a bank that has lost its primary growth engine. They see a bank under permanent foreign supervision. They see a bank that cannot articulate a clear path to expanding shareholder value. So they sell. This is vanishing in real time. Between the announcement of the asset cap in early 2025, TD's stock price relative to its peers has declined by a measurable margin. Not a crash, not a panic, a slow, grinding repricing that reflects the new reality. TD is no longer a growth story. And once this shifts, everything above it starts to shake. Let me show you the contagion. When TD's valuation suffers, it creates pressure on every other Canadian financial institution because global investors don't parse the nuances. They see Canadian bank facing US regulatory issues and they start asking, who's next? Royal Bank's US exposure gets scrutinized. Bank of Montreal's California operations get questioned. Insurance companies with US subsidiaries start trading at wider discounts. The entire Canadian financial sector begins to trade with what market analysts call regulatory risk premium. This part is non negotiable. Canada's financial sector represents roughly 30% of the TSX by market capitalization. When that sector underperforms, the entire Canadian equity market underperforms. Your RRSP, your TFSA, your pension, they all suffer from the contagion. Here's the moment the clock actually starts, because we haven't even reached the breaking point yet. The asset cap is still in its early phase. TD is still complying, still shrinking, still hemorrhaging opportunity. But there's a limit to how long this structure can hold. At some point, and this is where the domino sequence accelerates, TD will face a binary choice. Either remain shackled indefinitely, accepting permanent second-tier status and watching competitors grab market share, or execute what bankers call strategic divestiture. Let me be precise about what that means. Strategic divestiture is corporate speak for giving up. It means TD would spin off or sell its U.S. retail operations entirely, extracting whatever value it can and retreating fully to Canada and whatever other markets it can access. This sounds like hyperbole, but it's not. We have precedent. In 2021, HSBC announced it was exiting the U.S. retail market after years of regulatory pressure and compliance costs. The bank sold its U.S. branch network to Citizens Financial and refocused on Asia. HSBC is a trillion-dollar global institution, and even it decided that U.S. regulatory burden wasn't worth the fight. TD is a fraction of HSBC's size, and TD is already under the weight of an asset cap that HSBC never faced. And here's where the cascade becomes unstoppable. If TD exits the U.S. market, it doesn't just lose revenue, it loses relevance. In global banking, scale matters, connectivity matters. A bank that operates only in Canada, a country of 40 million people, cannot compete with institutions that operate in markets of 300 million or a billion. TD would shrink from a North American bank to a regional player, and regional players trade at regional valuations. Here's what that looks like on the ground. Your TD shares held in your retirement account would face another repricing, this time permanent. The bank would become a utility, paying out dividends from a slowly declining asset base, a zombie institution that exists but does not grow. For pensions, this is catastrophic. The Canada Pension Plan doesn't just need stable dividends, it needs growth to keep pace with demographic obligations. As baby boomers retire, the CPP needs returns. A utility version of TD doesn't provide those returns. But this isn't even the part that scares me. The part that should terrify every Canadian is the sovereignty implication, because this isn't just about one bank. This is about the power dynamic between nations. Let me show you the real mechanism at work here. The United States has demonstrated that it can, through regulatory action alone, control the strategic decisions of a foreign, systemically important institution. No troops, no sanctions, no formal economic warfare, just the stroke of a regulatory pen. And this is where common sense actually becomes your enemy. Common sense says, well, TD broke the rules. They deserve punishment. And yes, TD's anti-money laundering failures were real and serious, but punishment and control are not the same thing. A fine is punishment. You pay it, you reform, you move on. An asset cap is control. It is ongoing. It is indefinite. It is a mechanism that allows a foreign government to dictate the size and scope of your operations for as long as they choose. This is the detail even analysts tend to miss. The asset cap has no expiration date. It remains in place until the OCC decides, at its sole discretion, that TD has sufficiently reformed its compliance systems. There is no objective standard. There is no timeline. There is no appeal process. TD is operating at the pleasure of U.S. regulators, and the moment they forget that, the cap tightens further. Let's cut through the noise. This is financial colonization. Canada thought it was building an integrated North American banking system where capital and services flowed freely across borders. What we've discovered is that the border is not a line, it's a gate, and the United States controls the lock. And here's where the countdown quietly began. Because the asset cap doesn't exist in a vacuum. It exists within the architecture of the USMCA review coming in 2026. It exists within the context of potential Trump administration trade policies. It exists within a geopolitical environment where economic coercion is the preferred weapon of choice. This is not theoretical, it's observable. The United States has shown with TD Bank that it can weaponize regulatory authority to achieve strategic objectives. And if it works on TD, Why wouldn't they use it elsewhere? Here's the part nobody expects. The next time the United States wants Canada to make a concession on dairy tariffs or aluminum exports or digital services taxes, they won't need to threaten broad economic sanctions. They'll just call TD into a meeting and suggest that perhaps the asset cap could be reconsidered if certain policy outcomes were achieved in Ottawa. This sounds insane, but the data is unambiguous. Regulatory authority has become a tool of statecraft, and Canada has just discovered that it has very few defenses against it. We don't have months. This is happening in days, and this is the crack that becomes an earthquake. We are now standing at the convergence point. Three distinct forces are colliding simultaneously, and each one amplifies the others. This is not a single crisis. This is a structural trifecta that is rewriting the rules of Canadian economic sovereignty in real time. Force one, the $434 billion asset cap, the hard ceiling that prevents TD from growing its most profitable operations. Force two, the forced asset shrinkage, $48 billion liquidated, not by choice, but by regulatory decree. TD is not managing expansion, it is managing contraction. Force three, permanent U.S. regulatory oversight. American compliance officers embedded in a Canadian institution with veto power over strategic decisions, with indefinite authority, with no expiration date. Let me be precise. These three forces do not operate independently. They form a reinforcing loop. The asset cap forces shrinkage. The shrinkage proves TD cannot self-correct without supervision. The supervision justifies extending the cap round and round, tighter and tighter. This was inevitable the moment the cap was imposed. And here is where we must shift our focus from the mechanics of finance to the psychology of nations. Because what is happening to TD Bank is not fundamentally a banking story. It is a story about how power works when the weapons are regulatory instead of military. Let me show you what I mean. Human beings are hardwired to believe tomorrow will look like yesterday. This is called normalcy bias, and it is one of the most dangerous cognitive traps in crisis. Right now, millions of Canadians are looking at TD Bank and thinking it's just a compliance issue. They'll fix it. Things will return to normal. But here's where common sense actually becomes your enemy. Normal no longer exists. The architecture of Canadian banking independence was built on an assumption that cross-border financial integration meant mutual respect, reciprocal treatment, partnership. The TD asset cap has shattered that assumption. What we are witnessing is not a temporary regulatory action. It is the unveiling of a permanent power structure that was always there, hidden beneath the veneer of free trade and friendly relations. Canada thought it was building wealth in the US market. What it was actually doing was building vulnerability. Let's cut through the noise. Every dollar of assets TD holds in the United States is a dollar that can be frozen, capped, or controlled by US authorities. Every branch is a pressure point. Every employee is subject to US labor and regulatory law. Every strategic decision can be vetoed. This is what dependency looks like when the curtain is pulled back. And here's the moment the clock actually starts, because the TD situation is not occurring in isolation. It is happening against the backdrop of broader US economic nationalism. We are entering an era where economic sovereignty is being reasserted by major powers, where the free flow of capital is increasingly conditional, where regulatory authority is weaponized. Here's the part they never put in the official reports. The United States is discovering that it doesn't need tariffs to control foreign economic behavior. It just needs jurisdiction. and jurisdiction is everywhere. Every foreign bank with U.S. operations, every foreign company with U.S. subsidiaries, every foreign pension fund with U.S. assets, all of it is subject to U.S. regulatory discretion. TD Bank is not an exception. It is a preview. This is where the domino sequence accelerates beyond finance and into geopolitics. If the United States can control a Canadian systemically important bank through regulatory action, what else can it control? Energy companies with U.S. pipelines, manufacturing firms with U.S. factories, technology companies with U.S. data centers. The precedent is now established. The mechanism is now proven, and this part has already begun. Let me show you the prediction. Within the next 12 to 18 months, TD will face its moment of reckoning. The bank will either secure relief from the asset cap, unlikely given the political environment, or it will begin the process of strategic withdrawal from the U.S. market. If TD withdraws, the stock will face another major repricing. Institutional investors will flee. The Canada Pension Plan will absorb billions in losses. Every Canadian with TD exposure in their retirement portfolio will feel it. But if TD stays under the cap indefinitely, the outcome is almost worse. The bank becomes a permanent hostage, unable to compete, unable to grow, bleeding opportunity to rivals who are not shackled. Either path leads to the same destination, the diminishment of Canadian financial power. This part isn't a prediction, it's math. And now we arrive at the psychological pivot, because this is the moment where we must stop talking about TD Bank and start talking about you. What I am about to tell you is uncomfortable, but it is necessary. The TD asset cap is a mirror. It reflects a broader truth about wealth, sovereignty, and control that most people never confront until it's too late. Here's the truth. You do not own your wealth. You own a claim on wealth. And that claim is only as good as the system that honors it. Your TD shares are not bars of gold sitting in your basement. They are electronic entries in a brokerage account, denominated in Canadian dollars, valued by markets that operate under rules you did not write and cannot change. When U.S. regulators decide to cap TD's growth, your wealth doesn't just decline, it is revealed to have been conditional all along. Conditional on regulatory approval, conditional on geopolitical stability, conditional on the goodwill of foreign governments. This is what I call the money illusion. You look at your portfolio and see numbers going up. You become a millionaire on paper, but those numbers are not wealth. They are promises, and promises can be broken. Let me be precise about what this means. If you hold TD stock directly, you are now holding an asset that is partially controlled by a foreign government. Your returns are subject to decisions made in Washington, not Toronto. Your growth potential is capped by the OCC, not by market forces. If you hold TD through a mutual fund or ETF, you have the same exposure, but with less transparency. You might not even know how much TD is in your portfolio until you check the holdings. If you hold TD through your pension, you have even less control. You are entirely dependent on pension fund managers to navigate the new reality, and most of them are still operating under the old assumptions. This is where the no escape encirclement tightens. Stocks, liquidity is draining from Canadian financials under regulatory pressure. Bonds, TD bonds trade with credit risk premium now that the bank's growth is capped. Cash, inflation is eroding purchasing power while the Bank of Canada tries to navigate an impossible policy trade-off. Real estate, Canadian housing is intertwined with banking health. If TD stumbles, mortgage markets shudder. So what do? Here's where everything changes. The answer is not to panic. The answer is to fundamentally rethink what safety means in a world where regulatory authority can override market forces. Let me show you the binary choice that every investor must now confront. Do you own assets or do you own claims on assets? A share of TD stock is a claim. It is a legal promise that you own a piece of the bank's future earnings, but that promise is mediated through markets, through regulations, through institutions that you do not control. An ounce of gold is an asset. It is a physical thing that exists independent of any government's approval, any regulator's decree, any market's valuation. This is not a conspiracy. It is a stated reality of the financial system. When you own TD stock, you are betting that the system will honor your claim. When you own gold, you are stepping outside the system entirely. And this is where we arrive at the core insight of this entire analysis. The TD asset cap is a warning shot. It is telling you that the system you trusted to honor claims is now subordinate to political power. What US regulators did to TD, central banks can do to currencies. What the OCC did with an asset cap, governments can do with capital controls. The transition from illusion to reality is accelerating. Let's cut through the noise. Gold and silver are not investments in the traditional sense. They do not generate yield. They do not pay dividends. They do not grow earnings. What they do is exist outside the architecture of claims and counterclaims that defines modern finance. When regulatory authority can freeze a bank's growth, gold cannot be frozen. When geopolitical tension can destroy cross-border financial relationships, gold has no counterparty. This is what it means to own assets instead of claims on assets. It is not about getting rich. It is about stepping out of the line of fire. And here is where the countdown quietly began. Because we are entering a period where financial sovereignty will be tested repeatedly, the USMCA review in 2026, potential shifts in US trade policy, ongoing tension between resource-rich nations and capital-rich nations, all of it creates friction, all of it creates risk. And all of it suggests that the rules you grew up with, the rules that said diversified portfolios in stable institutions were safe, are being rewritten in real time. History favors the prepared, and the window for preparation is closing. The TD asset cap proves that even systemically important institutions in stable democracies can be subordinated to foreign regulatory power. If it can happen to a bank, it can happen to any institution that operates across borders. Your portfolio is not exempt. Your pension is not exempt. Your claim on future wealth is not exempt. So here is the final question you must answer for yourself. Are you holding assets or are you holding promises? If you are holding promises, you are trusting the system to honor them. And the system just showed you with TD Bank that it will honor promises only when politically convenient. If you are holding assets, physical gold, land you can walk on, things that exist independent of institutional approval, you are no longer dependent on that system's goodwill. This is not fear mongering, this is pattern recognition. Friends, the TD asset cap is not a banking regulation. It is a symptom of a world where economic power is reasserting itself through jurisdictional control. And in that world, the safest position is not the highest yielding position. It is the position where no regulator in Washington, no bureaucrat in any capital can reach. The liquidity tide is going out, and we are about to find out who is swimming naked. The choice is yours, but the window is narrowing. Thank you for being here today.